there. Tom Hayes, I want to stay on China, though, because obviously there's a lot of talk, of course, about economic partnerships. We know that Xi Jinping met with Bill Gates last Friday before he even met with Antony Blinken. Elon Musk recently came back from China, Jamie Dimon, China. That relationship and what you heard this morning from the two leaders, what do you make of it, and does it impact how you invest right now, Tom?
Yeah, Cheryl. Well, I think this is a step in the right direction. We'll compete vigorously where it makes sense, but we'll also cooperate where it's in our best interest. And I think Xi came out and said that progress was made and they've reached agreements on certain issues. They were pretty vague about which issues. Blinken called it candid and constructive. So you have the positive news on that front, and you have the negative news. Goldman cut GDP from 6% to 5.4%. because they're worried that the stimulus is not going to be aggressive enough. We do think that the stimulus will be aggressive in the back half. They did cut short rates last week. They are going to do more moving forward. But what you really need to keep in mind, Cheryl, is that emerging markets in China is basically a currency trade. And if you remember, the U.S. dollar really rallied aggressively into those debt ceiling talks. And once that was resolved in the last few weeks, the dollar has been weakening again. It's resumed its downtrend that it started in October. And companies like Alibaba have been up 18% in the last few weeks. So we think on a relative basis, if you look at all the gains in the United States year to date, a lot of them were driven by big tech. We actually think the relative value trade for the second half of this year, with the dollar resuming its downtrend, is going to be in emerging markets and some Chinese tech like Alibaba, et cetera, that have really been beaten down. They've done nothing for 12 months, but we do think we're going to see that back half recovery on a relative basis.
So you're not concerned about kind of this cooling relationship between the United States and China? I mean, you're willing to make that trade and do the investing. I think that's interesting. You know, you also talked, Tom, about catch-up stocks. You mentioned the rally with technology, with the NASDAQ. I think, the S&P is up 16% year to date. What are the catch-up stocks that you're talking about, Tom?
Yeah, I think you got it exactly. What you saw was the bulk of the rally up until about a month ago was driven by the Magnificent Seven, those big tech stocks. 93% of the S&P had about 0% returns year to date up until about a month ago. So as the dollar resumes its weakness, what we're going to see is benefits from multinational companies who get more than 50% of their revenue from abroad as the dollar weakens. So think Intel gets 82% of their revenues abroad, 3M 49%, PayPal 47%, VF Corp, stuff like Stanley Black & Decker, et cetera. So we think those companies, the emerging markets, and biotech as risk comes back on. And we've got a couple of stocks here that are down 80% since their pandemic highs that also offer value. One of them is PayPal. People are worried about the competition for PayPal. They get just about half of their revenues abroad. They've got 435 million users, 22.3 billion transactions. And we think a lot of the bad news is priced in, a lot of the fear. It's now trading at 11 times forward earnings versus 33 times average. So we think there's a lot of value here as they get a new CEO and as Elliott Management has been active in the stock.
I was going to ask you about your stock picks. You beat me to it. Stephen Short.